Hello everyone, welcome to Insurance Business TV and our Q3 Canadian Professional Risks Power Panel. Now in this edition, we're going to be delving into everything from aggressive market pricing to AI washing to ever-increasing claims costs. And to take us through it all, we welcome back Candice Petris, National Practice Leader Professional Services at Purves Redmond, and a new set of panelists. First, Connor Yeo, Advisor Commercial Lines at HK Henderson Insurance, Natalie Chan, Senior Risk Advisor Specialty Commercial Insurance at Waypoint Insurance, and Alexis Rive, National Broking Leader Professional Services Group at Aon. So welcome everybody, and let's start with an act that came into force, of course, in January 2024, which requires many Canadian firms to report on forced labour in supply chains. Now, it holds directors personally liable with fines up to 250,000 Canadian dollars if reports are late or inadequate. So how should brokers advise Canadian corporate clients and indeed the D&O carriers on reviewing policies to confirm coverage for fines or penalties tied to this new act, particularly whether Side A only or excess layers need adjustment? Candice, as you are the veteran of this group, I will start with you.
Hi, thank you, Paul. I'd start by responding that fines and penalties are generally excluded under traditional D&O policies. And while you might have some coverage to final adjudication and maybe some allocation under the policy, it's best for us as insurance brokers to review the wording and try to carve out or reduce the exclusion as much as possible. If that is not available, certainly sell a client a Side A DIC policy, which would drop down to cover the fines and penalties for claims made against the directors personally.
Okay, excellent start. Is that something you would agree with, Connor, as well? And I imagine client education is really important.
Yeah, for sure. I mean, obviously, what I definitely agree with what Candice said, and then I always kind of want to lead on client education first. So, bringing that awareness and educating the client on where that risk lies is the first step, and then hopefully you can the first line of defense should be some level of policy procedure. Whether that is increasing governance or some internal auditing procedure, and then finally, maybe a board level review sign off.
Okay, and I imagine as well, Alexis, if I can bring you into this, it's really important to be engaging with legal counsel, isn't it?
Yeah, absolutely. I think it's important to work with legal counsel to determine the types of fines and penalties. As Candice mentioned, criminal fines and penalties are, of course, excluded under the policy. It's just outside of good practice to ensure those. So really working with legal counsel, determining whether the policy would respond to cover administrative or civil fines and penalties is a good course of action. And, reviewing your corporate personal indemnification agreements as well to see if there's some coverage there. And then that would, of course, work in conjunction with your D&O policy to provide coverage. As Candice mentioned, best practice would, of course, be to consider purchasing your Side A difference in conditions policy, as that has broadest coverage available generally in this arena. So that would round out to be sort of a robust solution for these new potential fines.
Yeah, I think that's really important as well, isn't it, Natalie, that we're examining the coverage structures of our D&O policies here.
Yeah, absolutely. I agree with everything that my esteemed panel members here have said. Really looking at the layers of coverage, because as each layer must be reviewed, as excess layers may include different terms and conditions that are maybe more limited or broader. I would also add to review other liability policies for any possible supplemental protection.
Of course, no insurance conversation is complete right now without some talk about AI. So here we go. There are reports that boards are seeing more claims tied to overstatements about technology and AI. And indeed, cyber events are now triggering D&O exposure due to insufficient governance oversight. So what protocols should brokers implement to assess and mitigate the risk of AI washing and technology misrepresentation? Indeed, to align D&O and E&O placements with clients' governance and cyber oversight practices. Alexis, any thoughts on this?
I think, we've got sort of a general list of 5 potential ways that a broker could sort of help. The first is with risk assessment and due diligence. Really, brokers should help implement robust protocols to assess clients' technology and AI-related statements, including reviewing public disclosures, scrutinizing press releases, investor presentations, and marketing materials for potential overstatements about AI or technological capabilities. This could also include interviewing key stakeholders, engaging with leadership, IT, and compliance teams to understand the actual functionality and limitations of any AI or technology being promoted, and providing some benchmarking, comparing clients' claims to industry norms to identify potential exaggerations. The second way that brokers can help is through governance and oversight evaluations. So, assessing AI governance frameworks, ensuring clients have documented policies around AI development, deployment, and monitoring, including ethical guidelines and risk management processes, reviewing board oversight and confirming that the board is actively engaged in technology risk oversight and receives regular briefings on AI, cyber, and technology initiatives. And the third way is through ensuring alignment of your D&O and your E&O placements. Brokers can assist to tailor coverage and work with the underwriters to ensure that D&O and E&O policies explicitly address exposures from technology misrepresentation and cyber events. It might include specific coverages for regulatory investigations or shareholder actions tied to AI and technology disclosure, or E&O enhancements for technology errors, omissions, or failures. And of course, performing a gap analysis to see where they might have potential gaps between E&O, D&O, and cyber insurance. I think a best practice here is trying to use the same insurer for your D&O and E&O placements, and certainly same broker for these coverages to ensure that you can perform these analyses accurately.
Yeah, I'm impressed that Alexis has been able to come up with such a formal plan there, Connor, because there's no real precedent, is there?
Yeah, that's true. So yeah, currently no actual legal precedent for this type of risk, but it's not to say that that risk isn't there. What I actually really liked what Alexa was talking about was that interaction of your E&O and D&O. So I would actually, I'd very much agree with what she has to say on that, and making sure that those two policies are aligned. The last thing you want to have is two insurance companies pointing their fingers at each other and you standing in the middle looking for coverage. So definitely, making sure those two policies are aligned and you have an understanding of where coverage is going to lie at the end of the day.
Yeah, make sure those two policies are aligned and be really diligent with auditing as well, Natalie.
I would agree with that. AI is really a hot buzzword these days. For those of us have been long enough to remember in the past, think back to Y2K exclusions, the dot-com booms. AI is certainly a hot topic, and as Connor said, there is really no precedence. So it's really about educating our clients as to what they can do, the protocols that can be put in place as of right now, with a lot of uncertainty where underwriters don't know, brokers don't know, clients don't know. So certainly a bit of a wild, wild west.
Yeah, and I'm just wondering as well, Candice, I mean, it's all well and good as coming up with these ideas, but we really need some advocates on the board as well, don't we?
Yes, my concern is that some boards don't have a technology advocate, and someone at the firm, at the board level, should understand some technology and be responsible for the strategic oversight over the chief technology officer or a technology specialist. So as long as there's someone who is responsible, then it continues to be a board level concern.
I want to throw something at you from a personal experience as well, because speakers at a recent Toronto insurance conference noted that new entrants are aggressively undercutting existing professional liability markets, especially E&O for brokers, with flat or even declining rates despite costly claim exposure. So how can Canadian brokers balance that sort of aggressive market pricing against the potential under-reserving for future claim costs? And indeed, what value-added documentation or advisory services can help preserve that underwriting soundness? Natalie, what are you making of the market right now?
It certainly it makes it a very difficult market for all of us on the broking side. I think it's really important to educate clients about the differences, the nuances between where you're buying your insurance from. An actual domestic carrier versus a wholesaler. The way their financial strength, their backing, as well as their claims paying history, and their exit patterns of potential opportunistic carriers. So make it very clear to our clients that a 10 to 15% savings today premium on your premium could potentially mean a delayed or denied claims in a few years down the road. So that's really important to have those conversations with our clients.
I'm just wondering as well, Candice, from what you're seeing, any people in the market getting a little bit nervous?
Yes. And I think that the market disruption in the insurance broker and MGA E&O area is long overdue. There's been 2 Canadian programs for the last 25 years with global insurers using 2 program insurance companies. And it's been very frustrating for new insurance companies to quote against these programs because often they're leveraged and have very low quote to bind ratios. So competition doesn't necessarily mean that the new market entrants are aggressively quoting professional liability insurance. Just wanted to make a caveat that while brokers expect competitive premiums, they really also want to support other independent brokers and not worry that their financial information will be exploited for acquisitions later by global brokers. And they also get frustrated getting their E&O quotes from one broker who later competes with them on their key clients. So we have to keep in mind that the insurance companies, most of whom are North American based, are sophisticated and they have sound underwriting practices. So if people are nervous that there's new competition, it just means they have to step up.
Okay, I like that. Strong words there from Candice. So are you a big believer in competition as well, Connor?
Yeah, and I definitely fall in the same camp as Candice here. So yeah, my thoughts are kind of twofold. First, I definitely think, generally speaking, competition is a good thing for clients. And, I think that's my capitalist view shining through. But, I think as a broker, our role isn't just to find that, you have a balance, obviously, right? Like, the aggressive, call it aggressive pricing if you want, but what our role as a broker is to find that balance, right? We want to find the best solution and most sustainable pricing for our clients while maintaining, making sure that we have a strong partner in the insurance company. Yeah, especially with E&O, these claims can happen years after something happened, and we want to make sure that those insurance companies are there for us, 5 or 10 years down the road.
And education obviously is going to play a vital part as well, Alexis.
Yeah, exactly. I agree with what Connor said. I think it's, also sort of incumbent upon the broker to ensure that we're doing our clients full service by providing fulsome underwriting information to the new market entrants so that they have clear understanding of, loss performance, loss history, activities to ensure that they are not undercutting the price and pricing the risk adequately so that we don't run into these under-reserving issues later on down the line.
Well, just changing pace with you all a little bit. Recent case law has sort of underscored broker liability when commercial property or corporate building limits have not been updated to reflect post-COVID inflation. That's leaving some clients exposed and indeed brokers vulnerable to E&O suits. So what steps should Canadian brokerage firms take to audit client coverage limits, to communicate inflation adjustment warnings, and indeed to document client decisions to mitigate those E&O exposures? So Connor, any thoughts?
For sure. Yeah, I might sound like a broken record here, but client education is first step, right? So, like you said, the inflationary market of construction materials is increasing drastically. So, we need to educate our clients in the cost of rebuilding their property. We're not professional property evaluators, so we can't really do that part of it. But educating them that this is a risk. And then having those conversations and document those conversations religiously. And then, I think we can, as brokerages, we can have better and, more sound policies and procedures when it comes to that. So, maybe you have some templated renewal workflows and checklists. And then hopefully at the end of it, you have a client sign off that agrees with everything that happened during that renewal.
Okay. Document everything along the way then, Alexis, and I imagine regular audits are necessary too?
Oh, absolutely. Yeah, I think regular audits are important just to ensure that, limit adequacy is matching inflationary trends. And certainly, as Connor already said, get written confirmation from your clients in writing. We need to have strong file documentation to ensure that clients are aware of our recommendations. we have done our due diligence, and if they are choosing not to agree with our recommendation, that we do have their refusal in writing.
And what about building valuations as well, Candice?
Well, depending on client size, it is recommended at appropriate times every few years. But if a client is too small, definitely recommend city location specific guidelines. And also to reassess midway through the year, especially a year where there is significant inflation. But ensure built inflation guidelines may not be adequate. So it can't be just the sole factor that we rely on. We really recommend having a strong client service agreement with your client, establish expectations, and define that we are not property appraisers. If those documents are signed, it will be helpful should a claim ever occur.
Okay, so some great tips there from our panelists. Natalie, anything to add on this one?
I mean, I agree with everything that Connor, Alexis, and Candice had said. I would just add, we want to absolutely avoid auto renewals. We want to provide the tools and the resources to our clients, the building appraisers, suggested evaluators as a tool for them to help them determine, what they're going to tell us to insure their building for. And at the same time, can't say that's enough. Document. Communicate clearly and early with our clients and often, and making sure that we file this away in a very in a spot that we're not going to be able to not find down the road to avoid our broker's E&O, to Candice's earlier point.
Yeah, great stuff. And I just want to throw one final question at all of you, if I can. Of course, with everything that's going on in Canada at the moment, it would be somewhat amiss of me to not sort of focus on climate-related catastrophes as well, which continue to drive, of course, ever-increasing claims costs, insured losses, now averaging billions. So given these intensifying climate risks, how do you think brokers should reposition management liability programs to bolster defense cover, retentions, disclosure-based risk management, especially for firms in the insurance, energy, and infrastructure sectors, Candice, because they're particularly affected, aren't they?
Yes. First and foremost, use a specialist who understands wordings, including the BIPD, bodily injury, property damage exclusion. Some brokers who don't handle this policy every day may accept the exclusion as standard, but if it exists in the policy and your client has a stock drop due to a physical damage event, so think a tornado takes out their operating facility, that client may not have securities coverage. So make sure that you have a broad carve out or offer the client a Side A DIC policy that would not have this BIPD exclusion.
Okay, great tips. And I imagine risk modeling, Natalie, that's got to be at the forefront as well.
Yeah, absolutely. I would recommend utilizing CAT models to define some limits and making sure the underwriting makes sense. Pairing up with specialty carriers on bespoke policies and adjusting retentions and limits, and just making sure we're securing very strong aggregate limit layers.
Yeah, that's important as well, isn't it, Alexis, to really bolster those policy terms?
Absolutely. Ensuring D&O and management liabilities, providing robust defense coverage for climate-related claims, including any regulatory investigations and shareholder class actions that could be potentially related to climate disclosure or response failures, would certainly be important. As Candice alluded to, Side A enhancements or Side A difference in conditions policies can provide additional protection, of course, if the entity cannot indemnify due to insolvency or regulatory constraints, especially relevant after a climate catastrophe. So those are definitely some things that we would want to recommend.
Yeah, there's been some fantastic tips there. Connor, have they left you with anything?
Not a whole lot, to be honest. I think they kind of covered it pretty well. But again, on this one, there's no legal precedent right now to really reinforce the director's liability in these types of decisions that they're making. That's not to say that you can't be held liable. Obviously, legal precedent comes from somewhere. So, but maybe the last thing I would add on this is, we as brokers, we need to just be diligent in monitoring wordings on our D&O and E&O policies, making sure we're watching out for potential new exclusions for climate-related events.
All right. Well, fantastic thoughts and a really fascinating panel once again. Huge thanks to all of our panelists, established and new. Remember, they will be back one more time this year. So stay tuned right here at Insurance Business TV. you.